Hey everybody, this is David Skarika. So this is stock chart of the day for December the 7th. So I'll have one out tomorrow after the employment report. Sorry I didn't get this one out till the evening. But I write for a publication I've talked about in the past called Financial Intelligence Report, and I was actually getting my February issue done. I didn't have to get it done to the end of the month, but it just decided, the holidays coming up, just wanted to get it out early. It's a nice little side income I get for writing for them, and I like writing the articles. Actually, if you kind of miss my written articles, because I'm keeping this, I like doing this a lot better in this format. But if you go to look up Financial Intelligence Report, I'm kind of one of their better writers. Well, they have really good writers there, but they've told me I'm one of their writers. I talk about a lot of different things. It's kind of like, because it's a big publication, it's more focused on large caps, etc. Like I did an article today actually on interest rates. Looks like the Fed's going to cut, what sectors, what stocks to buy. And I talked about, and actually I did have one subscriber, so I haven't responded to your email yet, but you know who you are. And you asked me this guy wanted a video on dividend stocks. So maybe I'll do that, not this weekend, but the following weekend, because I want to look up some more dividend stocks, because dividend stocks, kind of like gold stocks, are a good sector to own when rates start going down, because all of a sudden the dividends look more attractive, right? So that's a good segue. So we're looking at interest rates today. Tomorrow's the employment report. By all instances, it looks like this could be a weak report. The private payrolls weren't very good. We're seeing the unemployment claims really come up. It looks like this is not going to be the greatest holiday season for hiring. So I think one reason that's going to spur these rate cuts next year is that we're going to see the economy really be at zero growth or in a recession. Canada had 2 quarters of negative growth, so they're basically in a recession. Not surprising considering he was prime minister there. So this is the TLT. You can see very good rally. I don't want to toot my own horn, but you can just go back and look at my stock chart of the day from a few weeks ago when I talked about bonds, and I was like, I really think interest rates have topped and they're going to go down. So we've seen this very good rally in the TLT. And of course, this is the one, I guess, argument you say for buying bonds, that if you think rates are going down, you just don't get the yield. You could have got a yield of 5% of, over a month ago, but you also would get the gain. Like the TLT has rallied from 82 to 95. So you've made like 15% plus you're getting that yearly yield of 5%. So that's a pretty good return on a bond. Of course, you got to time it right, because basically, other than buying, in October, you would have been down in the TLT any time buying the last few years. And like you can see how, and of course, the reverse goes for if you buy too high, because like if you would have bought the TLT at 150, you'd be down 30% right now, and the TLT would be like, your yield was 0.5%. So, it would basically take down, when you're down 30%, 0.5% would take, 60 years for you to get back your loss and that. So we're right at the moving average. Will it kind of conk out here? I think this is kind of a bottom. And if again, we look at that 10-year bond, you can see the yield is down to its 200-day moving average as well. And, I do believe we could see, we've gone, like I said, from 0.5%, we went to 5%. That's 450 basis points. Let's say we do a 50% retracement, that's 225. So you would get to about 275. So I think 3%, 3 to 3.5% is a fair, assumption on this next move if the Fed continues to cut. So we're looking at the IRX here, and you can see that really looks like the short-term rates have topped out. Kind of look at what they did in 2018, 2019. And then kind of by the middle of 2019, the Fed was cutting rates. And then if we go back, to the financial crisis, which is, God, I'm feeling old because financial crisis over 15 years ago. But you'll see the same thing kind of happen. Then the rates topped out in 2006, and the short-term rates didn't really start coming down to 2007, and then start cutting rates till mid-2007. But it looks like we're in one of these topping patterns for for interest rates. And like I said, if you kind of look at like the lower highs that were happening in rates, and now we're going to see higher highs, but nothing goes up in a straight line. I think again, going down to this, the 300, especially with inflation being about 3%, say it goes down about 2.5 at the low. rates being, 3 to 3.5%, I think that kind of makes sense. I don't think we're ever going to see that cheap money again that we saw from 2009 to 2022. And again, like things like I said, dividend stocks, emerging markets, gold and silver, a lot of crypto will do well. Looks like Elizabeth Warren's got a little issue with crypto. Maybe we'll talk about that another day. Yeah, that's kind of it right now. And so I just think, like, again, you look at that TLT chart. Let's just quickly look at the super long term. Always like to do that because I don't think enough people do this kind of thing, especially. I was going to show you something right now. We're going to look at this right now. I found this is kind of interesting. Maybe some of you who have, a lot of you are on iPhones, you probably have Apple Books. This might be worth your $10. I wrote a book called A Great Super Cycle. It was like my super long view, but I think, look at it. I talk about money printers and the coming inflation, the death of the bond bubble. I showed what bond prices had done earlier. So again, so we look at the bond rates here, this kind of lower highs and lower lows in rates. And of course, you can't go lower to zero, basically. So probably now we're going to draw an uptrend. So again, you go to 2.5 to 3%. That's kind of where you can draw your uptrend line, just like you had this like downtrend going on in rates. So that's probably what's going to happen. And rates don't go straight up. You look at the 50s, 60s, 70s, bear market and bonds, bull market and interest rates, that happens. So anyhow, this might be worth buying. It's not the whole book. I think the whole book is like 20 or 30 bucks. So if you want to buy the whole book, it is as well. But this chapter alone, you can buy, from Amazon for $10. I really don't see any of that money anymore. So I'm not making any money off this at all. But yeah, you could see this, and you can see, like I was talking about, too much money printing. There was going to be coming inflation. It took longer than I thought. This book was published in like 2010 or 2011. It took 10 years, but it did happen. And now we've seen that. And of course, now we've seen, like, look where rates were when I wrote that book. Zero on the short end. The TNX was, about 2% roughly. Now rates are more than double that on the long end. And the TLT, even though the TLT, went ultimately from, when that book was published, to 70 to 160, it's back down under 100. So, like, you can never, you can never time these things perfectly, but that's just an interesting book, the entry chapter. And like I said, most of you probably, or a lot of you have iPhones or iPads or the whatnot now, and Apple accounts. So it might be worth just a quick little read, as it is only a chapter as well. So it was just kind of like, the death of the bond bubble. And we saw the death of the bond bubble. But again, you look at this, it wouldn't be surprised to me, again, if this TLT rallies to 120 to 130 as a big significant bear market rally before it turns lower. Because what's going to happen is, people are going to like think, people want those zero interest rates back, especially if you have a lot of debt. You got a big mortgage on your house, especially in a place like Australia or Canada where housing prices are really out of whack. So anyhow, I'm just going to leave this here. I hope you enjoyed the little video. So interest rates, looks like they are doing that topping pattern. Like I've talked about, bonds doing a bit of a bottom here. If that unemployment report comes in weaker than expected Friday, I would expect even a bigger rally in bonds. And I can't really see a blow away report here because everything is pointing to it being weaker than expected. Obviously, you got Christmas shopping going on right now, so that could prop up things now. But I would definitely think that the first quarter of next year is going to be very, very dicey for economic growth. So I hope you enjoyed this, and everybody take care.